All right, let's get started. So welcome everyone, and thank you for joining us on this webinar where we'll be getting an overview of the key issues that fiduciaries are facing related to incorporating climate risk and other material factors into their investment process. And a big thank you to IEN's Fiduciary Duty Working Group for organizing today's webinar. So my name is Hannah Bowen, and I'm the network manager here at the Intentional Endowments Network. I'm just going to go over a few logistics for the webinar before handing it over to today's moderator, Keith Johnson. So a few points about the webinar. This is our first monthly webinar of 2020, and all of the participants on the line are muted, but you can ask questions or add comments, observations, anything that comes to mind at any point during the webinar using the Q&A function of this Zoom platform or through the chat box, and we'll be keeping an eye on those as we go through. This webinar is being recorded, and we'll distribute that recording to everyone who registered by email and post it on the IEN website so that you can refer back to this conversation and you can share it with others as well. So before we dive in, for anyone who's new to IEN, we are a nonprofit collaborative peer learning network where endowments and experts come together to advance the field of aligning their investments with institutional mission and sustainability and performance goals. And we do this through in-person forums and events, peer networking, sharing resources on sustainable investing opportunities, and providing educational venues like this webinar. And a big thank you to all of our network members who have been sharing your experiences so far. And we invite others on this webinar to become a network member. You can do that as an asset owner, an asset manager, another stakeholder to help us keep growing this movement. And there are a few ways to get involved right now. This webinar is actually designed as a bit of a preview for, or a conversation starter for, the Endowment Investing Forum that will take place during the 2020 Higher Ed Climate Leadership Summit. So if you haven't registered yet, there is still time before February 23rd to join us face-to-face in Atlanta. For those closer to New York, we have a small invite-only event, but there's more information about that on our website, and let us know if you're in the area and potentially can hop into that conversation or give us some ideas about future face-to-face convenings. And there's a time-sensitive opportunity right now to take action to protect shareholder rights. Again, more information about that on the IEN site. So always ways to engage, but today we're really focused on a learning opportunity and learning from the Fiduciary Duty Working Group. So I will hand it over to Keith to kick us off and get us started on today's topic.
Thank you very much, Hannah, and welcome everyone. I'm Keith Johnson. I'm the chair of the Intentional Endowments Network Fiduciary Duty Working Group, and am with Reinhardt Berner Venter, which is a Midwest law firm that advises institutional investors on investment and fiduciary duty issues. Previously, I was general counsel at the Wisconsin Investment Board, which is one of the largest public pension funds in the U.S. We appreciate the questions that we got from you in advance of this webinar. You identified things that you were looking for, and that included examples of how fiduciaries are considering climate risks and actual tools you can use in your own endowments and the vocabulary and frameworks to talk about those issues with your stakeholders. And we're going to try to cover most of that in the session today, and also get to as many of the questions that you have as we can. We're really lucky today to have a list of fantastic speakers. We have Susan Gary, who's a professor of law from the University of Oregon, Russ Goldstein, who is an advisor to individual and institutional investors with Bank of America, and Chris Fox, who's a senior director at Ceres. Next slide. So as Hannah mentioned, this webinar is really a precursor to the Higher Education Climate Summit and the Institutional Investor Network Endowment Investing Forum. Are you, Hannah, I don't see the next slide yet, so. One of the things that we were going to be focusing on at the forum in Atlanta is the Intentional Endowments Roadmap. And as you can see, I guess, go back a slide. Yeah, there we go.
Sorry about that.
The Intentional Endowments Roadmap is really sort of a fundamental tool for IEN participants, and you can see that it talks about the process of developing and thinking about the road to adopting intentional investment practices. If you go on to the next slide again now, basically there's been a substantial amount of confusion around terminology. There are a lot of different names for and different approaches to doing ESG investment. Some of the same terms that are used mean different things to different people. And Hannah, I don't know if you're on the next slide yet. That doesn't show on my screen yet. Really the confusion in terminology is a challenge in this field. So for IEN purposes, all of the different terms that are thrown around in this area, like intentional investment, intentionally designed investment, socially responsible investment, are used interchangeably, basically, to mean at IEN aligning investment practices with institutional mission and values, and or explicitly considering ESG risks and opportunities in the investment process. And it's a goal-oriented definition that we use without regard to the specific strategies that are used to implement the goals of intentionally designing an investment process. So there's room for both divestment and engagement with companies instead of divestment, negative screening, investing in best-of-class types of companies. The range of how you can implement moving to an intentionally designed investment portfolio is quite broad. Okay, next slide, please. And if you haven't registered yet for the Endowment Investment Forum, I encourage you to do so. The forum is going to be set up as a conversation between participants around using an investing framework to manage the risk and embrace the opportunities created by climate change. So today we're going to start off with some background that hopefully will give you a leg up on the forum. Fiduciary duty has often been cited as a roadblock to moving toward intentional endowment practices. And first of all, we've got Susan Gary, who is going to talk about fiduciary duty as it relates to ESG, sustainability, intentional endowment practices. Susan is a professor of law at the University of Oregon. She also is someone who helped write the Uniform Prudent Management of Institutional Funds Act and has published the current leading law review article on fiduciary duty and ESG investing. Susan also has served on the University of Oregon Board of Trustees, and we're really lucky to have her with us today. Susan, I turn it over to you to tell us why fiduciary duty is not a roadblock to intentional investing.
Thanks, Keith. And next slide, first slide. So not only is fiduciary duty not a roadblock, but I think increasingly it is fiduciary duty shows that the board needs to be considering climate risk as part of their investment strategies, and I'll talk about why I think that is so. When we talk about fiduciary duties, there are a number of them. The duty of obedience is the duty to carry out a university's mission. We're not going to talk about that much today, but that does tie in with how the university thinks about its endowment if it is going to link the endowment to mission. I want to focus primarily on the duty of loyalty and the duty of care, and I'll touch on the duty of impartiality at the end. I'm going to be going quickly because there's a lot to cover, but I think the basic points are pretty clear. So next slide. The duty of loyalty is the duty to act in the best interests of the beneficiaries of whoever the fiduciary is managing money for. In the case of a university, it's the university's mission. And the problem and the reason that there has been concern about fiduciary duties and ESG investing or socially responsible investing is that best interest has long been thought to mean solely financial interest. I would challenge that personally, but there is nothing legally available that says best interest means more than financial interest, with now a couple of exceptions in 2 states that I'll show you in a minute. But generally speaking, there's the idea that what a fiduciary needs to do is manage investments on a risk-adjusted basis, balancing risk and return to obtain the highest amount of return with the least amount of risk, and the risk tolerance depends on the investor. Obviously, climate change is creating a lot of risk for investors, and that's why ignoring climate change may be a problem these days. The other reason that people get hung up on fiduciary duties is that there is the idea that any consideration of non-financial factors can be a problem if doing so leads to a financial cost to the charity. With that, the next slide. And before I talk a little bit more about the fact that climate change is not a non-financial factor, I want to mention this beginning of a shift in thinking about best interest as going beyond financial interest. There are now 2 states that allow a trustee of a private trust to consider a beneficiary's personal values. And I think that is the beginning of a shift in thinking about how we think about best interests and whether it is more than financial return. There is already indication from the IRS that a charity can engage in mission-related investing, even if the returns are below market. But as we're going to discuss this morning, or it's morning for me, as we're going to discuss today, investing with an eye to climate change does not necessarily result in below market returns, and in fact may improve returns, and that's why it's becoming more important. Next slide. The Sustainability Accounting Standards Board has developed now industry-specific standards that identify financially material sustainability factors. And any prudent investor should consider material factors. And so part of the shift that's going on is the recognition that sustainability factors do have financial impact. Many more companies are now reporting their information about their ESG factors. A problem has been a bit of apples and oranges. The reporting has not been as consistent as would be helpful to the investors, but the companies are increasingly using more standardized reporting. There are more groups working on that. Next slide. Turning to the duty of care or prudence, and I use both words because both are used. It means the same thing. It's one duty. This is the duty that requires a fiduciary to invest the property as a prudent investor would. Next slide. The Prudent Investor Standard is found in 2 different statutes. The Uniform Prudent Investor Act applies to trusts, and UPMIFA applies to charities organized as nonprofit corporations. But basically the idea is that it's the kind of community standard. What would a prudent investor do? That's how the investor needs to invest, considering again risk across the portfolio. I want to highlight one of the things that a prudent investor is supposed to consider, which is diversification, because this has also been a hang-up, particularly around divestment. Part of modern portfolio theory posits that the best way to manage risk is to diversify across the portfolio. And in the early years of socially responsible investing, there were concerns that if you carve out a group of stocks, if you carve out a group of a sector of the potential investment world through divestment, that reduces diversification and therefore does two things. Therefore, will cause the return on a risk-adjusted basis to be less, but also would reduce diversification in a way that would be a breach of the fiduciary duty. Of course, the funds that were doing it way back when were diversifying in other ways that kind of got lost, but that's part of what the concern has been. And it relates to my general view that rather than divestment strategy, and I know Keith talked about all sorts of different strategies that may be appropriate, my own view is that looking at ESG factors as part of a financial analysis can reach the same result, but without the concern about diversification that divestment brings, and also without the kind of politically charged language. I think climate change is important in considering investment decision making. I think divestment, that word sometimes just gets everybody excited in ways that are not productive. And I think for boards, one of the questions we got was how we help boards think about this. I think boards are concerned about divesting related to climate, because if they say, yes, we are divesting related to climate, then the next group is going to come forward and say, we think you should divest from businesses involved with Israel because we're concerned about the Palestinians. There are a number of other divestment things going on, and I think that's part of the hang-up. I think there are other strategies rather than divestment that are useful. Okay, next slide. The Department of Labor Bulletin tells us that they consider ESG factors as potentially financial factors that will affect or could affect the economic value of the plan. That is useful because there is very little in the legal literature, other than things that a few of us have written, that says it this clearly. So that was helpful when that came out. Next slide. The connection between the duty of care and the duty of loyalty is this. There are lots of studies, and we're going to hear more of this information in a bit, lots of studies that show that using ESG factors can yield either equivalent or better returns than a fund without ESG factors. And if ESG integration does not involve a necessary reduction in return, then in terms of the duty of loyalty, remember no financial cost, in terms of the duty of loyalty, the fiduciary can engage in ESG integration. Next slide. And on the duty to be a prudent investor, that duty depends on consideration of material financial factors. Climate change clearly is a material financial factor these days. Therefore, my conclusion is that a prudent investor should consider material ESG factors. Next slide. And to back that up, we have these two recent letters that Larry Fink, the CEO of BlackRock, wrote, indicating that in his view, sustainability should be integral to the way that the BlackRock manages risk and constructs portfolios. This is a really strong statement that a prudent investor should consider, particularly climate. He's talking about climate change more broadly in making investment decisions. And I think that's an example of the shift that's happened really just over the past few years, an understanding of the importance of climate change as a financial factor. Next slide. Sorry, next slide. And a slide after that. And then finally, I wanted to touch on the duty of impartiality because I think this is important for universities to think about. Universities are investing for future beneficiaries as well as current beneficiaries, and investing on a long-term time horizon makes a lot of sense for any fiduciary thinking about more than just current beneficiaries. There are studies that show that ESG factors produce long-term value. They're more likely to have higher returns on a risk-adjusted basis in a longer time frame, and the studies that show the benefits are looking out over a longer time horizon of, say, at least 7 years. I'm not talking 20 years, but longer period of time. And obviously, climate change carries long-term risk, so it's important to consider the interests of the future students, the future faculty, the future contributions to society that universities make, as well as what's going on currently. And with that, I will hand things back to Keith.
Thank you very much, Susan. My takeaway from your presentation here is that intentionally designed endowment investing is indeed appropriate for institutional fiduciaries, provided that they use a thoughtful process and current data and expert advice in developing a strategy to apply it. One of the other issues that came up in a lot of the questions related to the return issues that have been mentioned, and how you get a board to engage in issues around sustainable investing. To help us get some background on that today, we have Russ Goldstein, who is an advisor with Bank of America to both individual and institutional investors. And Russ has got a master's in sustainable leadership from Arizona State and is also a chartered socially responsible investment counselor and a board governance trainer. So Russ, walk us through how you deal with those issues.
Absolutely. Thanks, Keith, Susan. So the big question, why should we care about ESG and sustainable investing? Next slide. Whether you're a skeptic or a believer, climate change has and will continue to impact your portfolio. Our Bank of America Merrill Lynch research team estimates somewhere around there will be a tsunami of assets poised to invest in what we call, quote unquote, good stocks. 3 critical investor cohorts that care deeply about ESG are women, millennials, and high net worth individuals. Based on these demographics, we estimate somewhere around $20 trillion of asset growth in ESG funds over the next couple of decades, equivalent to the size of the S&P 500 today. In addition, 70% of U.S. assets can't be analyzed without using ESG data. What I'm talking about here is intangible assets, assets tied to reputation, brand, intellectual property, human capital, and so on. Analyzing financial, and Susan mentioned this, analyzing financial metrics alone simply won't suffice anymore. We inherently know this from just all of our own work experience, right? So when you have happy employees, typically there are better run companies and better returns. So companies with a high employee satisfaction ratings on places like Glassdoor.com have outperformed those with low ratings by nearly 5 percentage points per year over the past 6 years. And the best signal of earnings risk that we have found within ESG data through our Bank of America Merrill Lynch research team is traditional financial metrics such as earnings, quality, leverage, and profitability don't come close to the signal that ESG data gives you on future earnings volatility or bottom line risk. And I always lean on this stat. So ESG could have helped avoid 90% of bankruptcies, 15 out of 17, in the S&P 500 between 2005 and 2015. The signals that came from ESG data for poor environmental and or social scores 5 years prior to those bankruptcies were loud and clear. And then lastly, good companies enjoy a lower cost of capital. And then think about your own credit score, right, for individuals. But for companies, it's really basically the same thing. Their risk profiles can drive, good versus bad companies. A better ESG score can lead to nearly 2 full percentage points lower in terms of risk capital cost. Next slide. So you heard from Susan. This hopefully now makes fiduciary sense. There will be plenty of information today and through the conference that talks about making financial and investment sense. So now what? How do we actually take this information, whether you have one board member or all board members, quote unquote, on board for thinking about an ESG framework and or sustainable investing? How do we actually build consensus in the boardroom, in the investment committee room, whether it be to adopt these principles, to codify your investment policy statement, to build a framework, to just simply define what fossil fuel free means? How do we actually do this? And most of you know this consensus building is both art and science. But it is critical to driving action for complex topics and decisions. Next slide. So let's look at board dynamics to better understand how we can build consensus. But before we dig in there, know that effective teamwork, board dynamics, and getting to consensus does not mean avoiding conflict. It's not what I'm talking about. It means actually encouraging a bit of conflict. It means drawing out all of the viewpoints and ideas, being committed to debate and analysis, active listening, giving constructive feedback, and hopefully being open to changing one's mind. In fact, if your board or investment committee is not voicing any differences in opinion, I'd be worried. It may be getting along too well and not thinking critically as a team. Next page, next slide. And so you'll see here just a picture of teams. So whether or not you know it or see it or feel it, your board actually has a culture, an internal culture. How they communicate with each other, how they act, how they work as a team, how they make decisions. It's already there, good or bad. And we know board work is a collective effort, and it requires a unique kind of teamwork among members. And in my opinion, and most of you probably know this on the phone, board dynamics are really interesting and really complex. But getting a board to function as a highly effective team is not easy. And getting to consensus on these topics, on these challenging and big topics, is difficult as well. Next slide. So here's a snapshot. A great chart to help understand sort of what we're dealing with when we're talking to our boards, to our investment committees and trustees. There's a great book called Practical Wisdom from Peter Eckel and Kathy Trower. It's called Practical Wisdom, Thinking Differently About College and University Governance. Lots of great ideas, anecdotes, and thoughts in that book. But just take a look at this chart and think this way. Put yourself in the shoes of your board members and committee members. On average, we spend, 6 to 8 meetings a year, give or take, 2 to 3 hours in those meetings. Maybe there's a social event. Maybe there's a retreat thrown in there. So in total, we're together roughly 25 to 30-ish hours for an entire year. And with lots of topics and lots of agenda items to deal with, there's not a lot of time to devote to new topics, broad topics that require a lot of time and expertise. So think about this, because the facts will say that 70% of time in the boardroom is spent with board members being spoken to. Reports, we've all been there, reports and reports and reports, and little time is left for strategic and or thoughtful dialogue. So if I do the rough math, the rest of the time, 30% of 25-ish hours is about 7.5 hours. I mean, put that into context of how you're trying to build consensus in the boardroom. 7.5 hours of dialogue in the course of an entire year around complex topics. We've got to use our time wisely. We've got to be intentional about the topics we're covering and the way we're doing it. Next slide. Here's a quick summary of a report from BoardSource. The website's right there, leadingwithintent.org. It's a great study. It's been around for about 20 years, and it just shows you very clearly on the bottom of that report card, board composition. We struggle as boards. We are talking a lot now about diversity, but the truth is the action isn't truly happening when we look at board composition. And it shows here again in this report card for boards. Only 1 in 5 chief executives strongly agree that they actually have the right board members on the board. Next slide. And so what are the challenges? Lots of them. We could spend hours on this topic alone. How do you build board action and consensus? We could talk for days on all this stuff. But, you know, is it the board work is episodic, getting together every few months, and there's not this consistent cadence? Is it complacency? Sort of what are you when you analyze your board, your investment committee, the people that you're working with to bring these topics into the conversation to build consensus? Where do you see the challenges that may be either on this list or maybe there's a lot more from this list that you need to consider? But, I mean, I think about overconfidence. So maybe on your investment committee you have private equity managers and hedge fund managers, mutual fund managers, and people like that on your investment committee. So they bring their opinions and their confidence to the room that they sort of know what they're doing and know how to respond to this stuff versus really spending time in dialogue on the facts and studies and researching things, right? So, and what if you actually missed a board meeting? Then it's 6 months before you start talking about this topic again. So we know there's a lot of challenges. I just want to throw that slide up there so you see that you're not alone. Lots of organizations, trusts, boards, and trustees are dealing with a lot of these challenges. Next slide. So where could you actually focus your time to build consensus in considering the challenges? Next slide. I pointed out a few things here. I'm just going to touch on them quickly. The board chair is really important, and we'll touch on that. But part of any good decision making is good preparation. So not just preparation for this specific topic. So i.e., we want to talk about climate change and/or sustainable investing or ESG framework in this next board meeting. Not just that preparation, but all of the preparation that's done consistently throughout the entire ecosystem of your board processes, your onboarding, the structure of your board. All of this stuff matters to build in a culture of inquiry, a way of getting to consensus, and so on and so forth. Next slide. Board chairs. You could see the list there. You might have to click through to populate them, hopefully. Yep, sorry about the animations. There's a few of them there. So, but the importance of the board chair or committee chair can never be overlooked when trying to build consensus and or action around the topic. A skilled facilitator, they absolutely have to be, right? We've all been in meetings, we've all been in many board meetings where the chair may let discussion stray. Maybe they don't curtail like a sidebar conversation. Maybe there's already an important thread of a conversation going on, but they let that sort of wither away, or just basically and simply they run a poor meeting. We've all been there. The chair's responsibility is all this on this slide, but also they've got to know who's in that room. They've got to know the personalities, the strengths, the weaknesses. Almost to some degree, they've got to have a mental map of who's going to jump out in the conversation or so on and so forth, right? So they've got to understand that. So when thinking about your board chair, does he or she have the skills to frame these conversations, to build consensus in the boardroom? And if not, then we should consider getting training because there's not a ton of it out there for board chairs or committee chairs to help build this skill set. Next slide. Governance committee, and again, apologize for the animations, but two things pointing out here for governance committee. Most governance committees are great at understanding their role in onboarding and building a board, but there's so much more to a governance committee. Education, consistent education efforts. These topics need to be weaved into conversations. And then I really point out on one of the bottom bullets, monitoring board meetings. Is there an inclusive conversation? Are board members engaged? Do they have the information on time? Are they framing conversations? The health and conscience of the board is built on the shoulders of the governance committee, and it's an important role that not many of them actually understand that they're supposed to be doing that and monitoring those things. Next slide. And then we've all been here, right? Board meeting versus board meetings. Board meetings should be a great place for debate and discussion and consideration, all these things. And effective meeting practices include comprehensive preparation, a clear agenda, strong facilitation skills, and time management. Boards spend less than 25 hours a year in meetings. 68% of boards meet 9 times a year or less per year, and 78% meet for 2.5 hours or less. And board member attendance is actually declining. So we have little time to do complex work is where I'm guiding to. So building consensus isn't just about preparing that topic, it's about all the other work that goes on throughout the year in building the board. And so here you see the elements of an effective board meeting, and you could see those: consent agendas, mission moments, strategic discussions. All of these things matter. Next slide. Celebration moments too. And we've got to have a culture of inquiry. Curiosity, one of the most important things to building consensus and having deep dialogue is curiosity. A quote that many of you are familiar with is, good boards ask good questions, but great boards ask great questions. And what separates the difference in good and great, a lot of times, is curiosity. Curiosity helps change behaviors and group behaviors in the boardroom. So are these in your boardroom? Does your board chair do these things? Are your board meetings run this way? And then lastly, last slide for me, how do you increase curiosity to gain consensus? We've got to break up board routines. We've got to give agendas an ability to breathe, like a fine wine. Too often we're populating agendas with nonstop information, and it doesn't give time for conversation and dialogue. Breaking up larger boards into smaller groups is always a great idea, and have fun with that too. In other words, if there's a few of the main voices that talk up all the time, we'll break those people up into different groups, or actually put them in the same group, in a smaller group, and see what happens. It's usually a fun exercise. Get social, make sure the board is spending time with each other to build that culture and that teamwork. And lastly, the quote from Peter Drucker is, culture eats strategy for breakfast. You've got to build these cultures and these habits into your board with a culture of inquiry to get to consensus over time and have more meaningful dialogue and conversations. I'll pass it back to you, Keith.
Thank you, Russ. I guess you can say that sustainable investing can add value. In fact, the way I look at it basically is that it's just good investing regardless of what it's called. But it does require attention to board processes and how the boardroom approaches the issues in considering intentionally designed investment is really a critical consideration. Thank you. One of the other areas of inquiry that we got a lot of questions on was best practices at peers, and how do other funds approach these kinds of issues? And to help us with that, we've got Chris Fox, who's a senior director at Ceres, and he is a master's in sustainability leadership, and is also a chartered SRI. He leads. that was Russ. Chris leads the investor collaboration initiatives at Ceres, and he actually founded the Ceres Investor Network on climate risk and sustainability. And before he joined Ceres, was the executive director of the Center for Environmental Citizenship. So, Chris, walk us through your slides.
Sure. Thanks, Keith. One quick clarification. I'm actually Chris Davis and not my esteemed colleague, Chris Fox, who is also an impressive fellow who also has a master's in divinity and also works in the Ceres Investor Program. So we do our best to confuse people about which Chris it is. And he indeed did found the Investor Network that I went on to lead. But you're stuck with me. So we've heard about how climate change and other ESG factors are and can be material financial and investment risks, and are therefore part of a board's or an asset owner's fiduciary duty to manage. So I want to talk a little bit about climate risk in particular, and a project I'm working on. We're trying to get at the evolving best practices for assessing and managing these risks. First, just a quick overview of Ceres. I know many of you may be familiar with our organization, but we're a Boston-based nonprofit. We work with both institutional investors and companies on key ESG issues from a business case perspective as investment and business risks and opportunities, and also try to work on systemic change in the capital markets to try to help them be more sustainable in terms of federal and state legislation and regulation. Next slide. So we have a couple of networks. We have actually more than 50 large companies we work with at a fairly senior level on sustainability as a core business strategy. And my part of the operation, along with a number of talented colleagues, is serving as staff to our investor network, which includes more than 170 asset owners and asset managers, including a number of endowments. It's a pretty big, diverse, big tent network of all sizes and shapes of institutional investors, from small college endowments to the largest pension funds in the United States and the largest asset managers, including BlackRock, which I've had the privilege of working with for the last decade on climate change as an investment risk and opportunity. So Larry Fink's letter was particularly heartening. And we also work with a coalition of nonprofits and are proud members of IEN. And a couple of my colleagues will be at and speaking at the event in Atlanta in February. So next slide. On to the subject matter at hand, climate change. So this should not be a big surprise, but climate change does create increasingly financial and investment risks and opportunities that can be material to a lot of companies and other kinds of assets that institutional investors hold, like real estate and agricultural interests, forests, and so forth. So we break climate risk into two basic categories, physical risks and transition risks. The physical risks are probably fairly familiar and are in the news around the world. Some of the impacts, extreme weather, more intense storms, sea level rise happening faster than predicted, droughts. Much of sub-Saharan Africa is in drought, as is often our Southwest. Wildfires, Australia has been on fire, California has been on fire, and then floods, particularly in the upper Midwest and other places around the world. And this is with 1 degree of Celsius of average global temperature rise, and we'll be awfully lucky to keep the average global temperature rise to 2 degrees Celsius. And then there are transition risks. The transition to clean energy and away from fossil fuels is accelerating. We've seen what's happened to the coal industry in the United States, virtually all in bankruptcy. The electric utility industry in Germany suffered a similar fate because they were too slow to transition away from coal. Policy and regulatory changes as carbon gets priced in various ways. And while our federal government is in reverse on climate change, an awful lot is happening in our states. California is the 5th largest economy in the world and a global leader on climate and clean energy initiatives that create economic risks and opportunities. Technology change, the shift to electric vehicles, battery storage, a whole lot of clean technologies to use resources more efficiently. Market trends and consumer preference, reputational risk. You've heard that 70% of a typical corporation's value is intangible, as Russ told us, and your reputational risk and what is said about you on social media can tank your share price, and people don't like polluters and climate laggards, it turns out. And then there's litigation risk. There's a lot of increasingly creative litigation being filed to redress climate change. Most of it hasn't been very successful so far, but many people cite a parallel to the tobacco industry litigation, which struggled for almost 20 years until it got traction, and then it got traction big time. So there's a lot of risk associated with climate change to companies and other assets in which you all invest. Next slide. So I'm working on a project right now with a number of colleagues on doing about 10 case studies on global asset owner best practices in portfolio climate risk assessment and management. That's a mouthful, so we call it PCRM. We're typically looking at pension funds of all sizes, but are hoping to expand the range of institutions. Would love to do a couple of endowments, some religious investors. Hope to get an Asian sovereign wealth fund, and this field is really evolving, changing very rapidly as investors realize, asset owners and asset managers realize that they have got to get a handle on climate risk, and also the flip side of the coin, the opportunities that all of these transitions are creating. We're going to be doing a panel at our Investor Summit on climate risk, which is in New York City on March 24th. Details can be found at ceres2020.org. We'd love to see a lot of you there. It's a great learning opportunity on climate risk and opportunity, climate science, climate policy, and we'll have people from all over the globe there as speakers. So we're pretty excited about this. It's an event we do in collaboration with the United Nations and the United Nations Foundation every 2 years. And I'm happy to say it's funded by an IEN member. Impacts Asset Management is funding this best practices case study. And thanks to Ken Laughlin, who I think may be listening onto this call, and his team at Impacts. And they're also a member of our investor network. Next slide. So how do you go about assessing climate risks to your portfolio? Not an easy question, and there are a lot of approaches being taken by a number of leading institutions and also those who are just getting started with this process. So first is fundamental investment analysis. You do your research on a company. You read their published materials. You look at what disclosures they've made. Have they disclosed their emissions, their carbon footprint, their strategy? You interview people at the company, hopefully beyond investor relations, to find out what's really going on. How ready are they for the transition to a low carbon economy? Are they diversifying their products and services? Where do they get their energy? And how far ahead are they looking at this issue beyond sort of the typical quarterly capitalism that we're so familiar with? A first step often is for an asset owner, for an endowment, might be portfolio carbon footprinting. What is the carbon footprint, the emissions that are coming from the assets that you own, the percentage of the companies and so forth? There are a number of data providers, service providers out there in the market that do that and do it well. It's a good start to find out, are your emissions greater or less than whatever benchmarks you're using, the S&P 500, the Russell 1000 for your public equities. That's a useful data point, but unfortunately it's retrospective. The data is from last year or yesterday, and you're looking in the rearview mirror. Some more useful forms of analysis would look forward on what's likely to happen with a company or an asset. One tool there is scenario analysis, looking at different scenarios in terms of physical risk and transition risk. If global temperatures or temperatures where your assets are rise 2, 3, or 4 degrees Celsius, and right now we're on at least a 3 to 4 degrees Celsius trajectory globally, what will happen in terms of storms, in terms of sea level rise, the physical damage to the assets? What will happen if the world is actually serious about the Paris Agreement and limits emissions to well less than 2 degrees Celsius, or limits emissions to limit warming to that, which 195 nations signed up for, and at least for a while the United States is still part of that agreement. So scenario analysis is an evolving field, but difficult to do because it requires a lot of assumptions, and there's a lot of uncertainty. But it's certainly a useful exercise to do for an investor, and there are various service providers that do scenario analysis. There's some good guidance out there on scenario analysis from the Task Force on Climate-Related Financial Disclosures, or TCFD, part of the alphabet of climate and investment these days, and worth looking at. There are starting to be quantitative risk models. There's a number of providers who are building these models and improving them. There are top-down models that look at macroeconomic impacts of climate change, and there are bottom-up models that look at asset-level response to, in terms of stock prices of companies or impact on physical assets like waterfront hotel portfolios and things like that. There's debate whether these models are ready for prime time and whether they give you sort of investment decision useful information. But the field is evolving rapidly, and I think the holy grail here is to quantify climate risk, so it appears on the Bloomberg terminal, and along with all the other financial metrics that make things real to financial analysts and portfolio managers. I mean, these risks are real, but unfortunately we tend to call them non-financial risks, which puts them in this category that maybe they're not as important and not as real, but I'm here to tell you that they're real and important. So just some sources, and we don't endorse any particular data providers, asset managers, or otherwise, but some of the names in the field you may be familiar with. MSCI provides a range of climate data and analytics. Standard & Poor's, S&P just bought Trucost, which is a leading climate and sustainability data provider. Moody's just bought an organization called 427 that has been a leader in physical climate risk data on a geographic and asset level scope. ISS, Institutional Shareholder Services, have a climate and ESG team. CDP, the old Carbon Disclosure Project, provides emission data on something like 8,000 companies globally. Sustainalytics, Bloomberg has a lot of climate data and ESG data up on their terminal. And there's a really interesting project that I'm involved with in an advisory capacity called OS Climate, standing for open source, that's trying to build an open source platform to model climate risk and opportunities and access all of the latest data. And I think it's worth watching that initiative. There are a lot of smart people and a lot of major institutions that are involved in it. Investment consultants, most endowments and other asset owners have investment consultants. They are rapidly acquiring climate risk assessment capabilities and are getting where they can provide some useful advice on this subject. I will have to say that until recently, most of the major investment consultants, at least in the U.S., were we would consider them lagging indicators in this field, but they're catching up as clients demand some support in this field. A number of asset managers provide data analytics, including the big ones: BlackRock, State Street SSGA, Goldman Sachs, and on the smaller, more sustainability-focused managers, Impacts has done some really interesting work. So there's a lot happening in the field. There's a lot out there. There's a lot of expertise and a lot of sources of help that you can get to try to get your arms around climate risk in your portfolio. Next slide. Okay, so managing risks. So let's say you've assessed the risks and figured out where you think they're material in your portfolio, or what asset classes or subclasses you're concerned about climate risk, such as your holdings of oil and gas companies, electric utilities, real estate investment trusts, and so forth, or forestry assets, which a lot of university endowments hold, agricultural assets, which can be highly impacted by climate-driven weather. So on the investment side, reducing your high carbon investments is something that a lot of asset owners are doing. Investing in low carbon indices and investing affirmatively in climate solution opportunities. Engagement, dialogues with companies. There are a few initiatives. The Climate Action 100 Plus engages the 161 largest publicly traded asset or emitting companies in the world. You can file shareholder proposals, and please vote your proxies. Policy advocacy. We do need a price on carbon, nationally and globally. And finally, disclosure, pushing for better corporate disclosure, and also looking at what you as an institution are disclosing about how you're managing your climate risks. Next slide. I realize we're running out of time. I need to wrap up here. I just commend to you, I don't have time to go into it in detail, but the subject of one of our case studies, and I think they're also an IEN member, is Wespath Investments and Benefits. They manage the pension funds and other financial assets of the United Methodist Church, so they're probably a little bit more like a university endowment than some of the big public pension funds, but they have a very comprehensive climate action plan grounded in their fiduciary duty to maximize their financial returns as well as minimize their ESG impacts and to try to cause some positive change in the capital markets. And they've invested about 8% of their portfolio in low carbon climate solution strategies. They've excluded companies that derive their revenues primarily from thermal coal mining and coal-fired utilities, and they do an awful lot on engaging companies, as well as their external asset managers. They're almost 100% externally managed, like many endowments. So they're asking the hard questions and evaluating their managers and how they're managing climate risk. So I will stop there and hope we have some time for a couple of questions.
Well, thank you very much, Chris. I think that we're going to have to ask people to hold on to their questions for the summit because we kind of are running out of time here. But it sounds like there is a lot happening at Peers that can be useful for people that are just starting to enter into dealing with this area. And Ceres has a lot of materials, I think, that will be highlighted at the summit in Atlanta, and I think also will be available on the Ceres website. So with that, I would like to hand it over to Hannah. I think we managed to get through answers to most of the questions that we had received in advance, but please do attend the summit and send any other questions in to us if there are other answers that you need. Hannah, why don't you take us out?
Yeah, thanks so much, Keith and Susan, Russ, and Chris for really covering a very broad topic and with some specifics. And so a big thanks. We had debated maybe doing an hour and a half for a webinar, and I can see there is definitely enough to have filled that time. But thank you, and thanks to Danielle and Nick and Lila and others who are sending questions in. We'll get back to you by email. And others, if this has prompted more need for discussion, that's a good sign, and we're ready to provide that space. So definitely send questions our way by email. Hope to see many of you in Atlanta or one of our other upcoming events our webinars. And yeah, please keep in touch and we will keep the conversation going. Thanks all.